Welcome back. In today's video, I'm going to talk about some strategies to set up your asset allocation when investing in index ETFs. Now, asset allocation is basically how are you going to divide all of your portfolio up into all the different stocks and bonds and whatever else you're going to invest in. So some things that you need to consider when you're thinking about your asset allocation is your risk tolerance, your age, your time horizon, your diversification, your rebalancing frequency, your geographic allocation. There's lots and lots of different things to consider when you're thinking about your asset allocation. That all sounds like a lot and it might scare you a little, but the intention of this video is to simplify all those things a little bit. Firstly, if you are saving for something under a 5-year time horizon, you probably don't want to invest in the stock market. You probably want to put that into somewhere safer. The stock market can be risky over a short term. Over a long term, it's very safe. But over a short term, like under 5 years, there's a chance that you could lose your money. And if you're saving for something short term, you probably don't want to lose that money. So for the sake of this video, I'm going to assume that you are going to look for long-term growth and invest for more than 5 years. Also in this video, I'm actually going to focus on the risk tolerance piece of asset allocation. I'll talk about other aspects of it, but this one we'll focus on the risk tolerance, and I'll have others focusing on different aspects of asset allocation. So risk tolerance is generally the first thing I have students or people that I'm helping out starting their investment journey think about. And when I have them think about their risk tolerance, I'll just have them start with a 60-40 portfolio. And what a 60-40 portfolio is basically you take 60% of your portfolio and you put it into riskier things like stocks, and then 40% into safer things. Generally, that is bonds when we're talking about a 60-40 portfolio. Why do I have them start thinking about a 60-40 portfolio to start with? That's because a 60-40 portfolio is considered a balanced portfolio. If you were to fill out an investment survey to determine your risk tolerance, or you saw a financial advisor and you filled out one of their checklists or something like that, generally for most people, the recommendation is a 60-40 portfolio, a balanced portfolio. And once they start with a 60-40 portfolio, I have them think whether that is a portfolio that suits them. Or would they like to go a little bit riskier? Would they like a 75-25 portfolio, an 80-20, a 90-10? Or even would you like to go 100% zero, 100% into equity or stocks, and 0% into the safer stuff, the bonds and stuff like that. Risk tolerance is entirely personal, and every person's going to be a little different based on needs and how risky they think they're willing to get with their investment portfolio. The riskier you get, so the higher your equity portion gets from 60 to 100, the higher likely that your investment returns will be over a long term, but over a short term, there's going to be a lot of bumps and rides and a lot of bigger downs as well. Most financial advisors will generally say a 100-0 portfolio will grow long-term about 8% annually, and a 60-40 portfolio, a balanced portfolio, they generally use numbers like 5% returns. And a growth of 3% over the long term is actually very significant and can make a huge impact on your portfolio. So why wouldn't everyone just choose a 100-0 portfolio or take more and more risks? There are several reasons that you wouldn't actually. One is that maybe you're getting older and older and you're not willing to take on as much risk because you know that you're getting closer to retirement and you're going to be forced to take out that money. The closer you are to an age or time frame that you're going to be withdrawing your portfolio, the less risk you want, right? If you're going to take out money for school or for retirement or a house in a year or so, can you afford a 30% drop in the market? You don't have that time frame to wait for it to recover. You probably want to take a little bit less risk and adjust your portfolio accordingly. I do want to note that a drop in the market or a loss in your portfolio only actually becomes a loss to your portfolio if you sell. So the stock market has recovered 100% of the time. Every time there's been a huge drop in the market has always recovered. If you can hang on to your money during those drops, then you can take some more risk. But a lot of people get scared. And if you can't handle a drop of 30% of your portfolio, then having bonds, having some safe stuff in there is probably a really smart decision. Bonds tend to go up when stocks go down, and they tend to go down when stocks go up. So the increase isn't as fast, but the drops aren't as deep either. So if a 100-0 portfolio drops 30% and you get scared because everyone keeps telling you it's different this time. That's a very common thing you'll hear when stock market drops. It's different this time. But a 60-40 portfolio only drops 15%, and that is enough to keep you from selling your portfolio. Then the absolute best thing you could do for yourself is to own that safe stuff, those bonds in your portfolio. I know when I first started investing, even a 2 or 3% drop in the market terrified me. I didn't even have very much money in the stock market, but the seeing the red all the time just does this to you psychologically. And I know Ed Rempel, he keeps saying this on his Unconventional Wisdom blog, risk tolerance is a learned behavior. And I couldn't agree more. The longer you're in the stock market, the more drops you see, you just learn to adjust accordingly, and you learn not to be scared of these drops. So the longer I've been investing, the more comfortable I am with these drops, and actually the more excited I get about these drops. When the stock market drops 20 or 30%, I look for extra cash to put more into the stock market because I know for a fact, I've gone through this, it is going to recover. It's not different this time. This is actually one of the biggest reasons I wanted to get my boys investing early in the stock market. I know the biggest reason people lose money is because they sell in the wrong time. And now my boys, they've gone through the pandemic, their portfolios dropped 30%. They're okay with it. They know, they saw how fast it recovered in this case. They know it's going to recover. They've seen these ups and downs. They're already at a young age comfortable with these drops, and they're not scared to continue to put money into it. They're not going to be scared off and sell at the wrong time either. I do want to note that I am a 100-0 investor. There's a few reasons for it. The big one, though, is as a teacher, I do have a defined benefit pension plan. I treat that as my safe stuff, my safe investments. Rather than having bonds, I have this pension that no matter how far the market drops, I'm guaranteed to get every single year. And another big reason is I'm comfortable with the drops. I'm willing to take that risk now. I'm comfortable with the risk. I'm okay with going 100-0. I know for a fact that about every 7 years, the stock market's going to drop 20, 30, we saw 50% drop at some point. I know it's going to happen and I'm comfortable with it. I'm not going to change my investment tactics or anything like that. So I have become comfortable enough that 100-0 suits me. 100-0 is not for everybody. You need to find what your risk tolerance is. Start with that 60-40 and think to yourself, is it right for me? Can I take on a little bit more risk? You don't have to go to 100-0. You could do an 80-20, whatever you feel like is comfortable for you. I hope this video has helped you sort of discover the risk tolerance you're willing to take. And if you're interested in any more of my videos, please subscribe below.